Hello and welcome to Interesting Times. Across the media landscape, the attention seems to have moved onto the tariffs and looming tariffs war. After weeks of speculation, finally President Trump held his board up, and as usual, the rest of the world went off in a synchronized fireworks display. As one Russian commentator put it, stock up on the popcorn, sit back and enjoy the show. The mainstream press in Russia reported on the tariffs, although Russia is not directly affected by the tariffs because of the wide-ranging US sanctions on the country. The US imports from Russia are fertilizers, some platinum, and nuclear fuel. Nuclear fuel imports are at the center of an ongoing spat between Russia and the US, with the Kremlin curbing exports of enriched uranium to the US as retaliation for the sanctions. In Russia, I think the focus is on the effect of the tariffs on their trading partners. Tariffs may strengthen BRICS and foster more cooperation among the members, and perhaps encourage further moves away from the dollar as the currency of choice for international trade. On the other hand, key partners such as China and India may need less Russian raw materials, oil, gas and coal as a result of a contraction in exports caused by the tariffs. An interesting idea I've come across originates from the Russian economist Igor Zelezetsky. Mr. Zelezetsky's view, as I understand it, is that the US Treasury needs to refinance about 9 trillion of public debt, which will require refinancing in 2025. Every year, $1 trillion goes to service the debt. The average interest rate on outstanding debt is 3.3%, according to Mr. Zelezetsky. But in the past, during a crisis, interest rates are reduced, and lower rates could help the US Treasury with the task of refinancing by effectively lowering borrowing costs. As Zelezetsky puts it, the willingness to accept short-term volatility for long-term changes demonstrates mathematical pragmatism, focus on key numbers rather than market sentiments or social consequences. Let's unpack this a little though. The tariffs can create economic uncertainty and fan fears of a worldwide recession. In the past, these fears and uncertainties have triggered the flight to safety. Investors seek out safer investment vehicles like US Treasury bonds. The heightened demand for perceived safe Treasury notes can drive down yields, and as more investors seek safe havens, yields will keep coming down. A strong demand for Treasury notes with very low yields will have the effect of lowering the interest costs associated with borrowing, thus making refinancing public debt cheaper. However, this strategy hinges on the US being perceived as a safe haven. To give you an example from the past, in the 2008 crisis, Germany was viewed as a safe haven, and investors flocked to buy German bonds, to the point that effectively they were paying €100 to get €90 back, or at least that was the estimate at the time. Well, Trump's tariffs have wiped Germany off the list of safe havens, but it is a risky strategy, and it relies on investors believing that Treasury bonds are a safe haven. The tariffs have put a lot of pressure on US trading partners. Japan seems to be looking to reinvigorate the Regional Comprehensive Economic Partnership. The RCEP is a free trade agreement among the Asia-Pacific countries. It's worth noting that China and a few others are also either members of BRICS or on the joining list. And Japan, according to the Russian press, has opened up for some quiet talks with Russia with regards to the disputed territory of the Kuril Islands. And of course, this type of talks offer also a place for some informal discussions on trade, for example. To recap, there is a bit of a wait-and-see attitude in Russia, and although Russia is not directly affected by the tariffs, we live in a deeply interconnected world, and eventually the wave hits every shore. These are the numbers for the Russian economy and the projections pre-tariffs. These are the Bank of Russia's numbers. These are the Bank of Finland's numbers. The Bank of Finland's insights are quite close, but perhaps a bit less optimistic than the Bank of Russia's ones. The Bank of Finland, or BOFIT, cites ongoing headwinds for the Russian economy. In short, persistent inflation affecting household income and spending, high key rates, lowering appetite for investments in sectors other than those benefiting from government investments in the military and associated sectors. All these pose long-term threats to the economic stability of Russia. However, in the short term, Russia's economy can still sustain the war effort. As noted by the Bank of Finland, a ceasefire and peace may be a threat to Russia's economic stability. This article on Gobi looks at the Russian budget as a military budget. The Russian economy has shown resilience despite sanctions, largely due to increased state spending on the war effort. This has driven economic growth, but at the cost of structural imbalances, where civilian industries and companies are suffering from low investment and labor shortages. The war machine in Russia is running at full capacity, and it suffers from now chronic labor shortages across the chain, from the factories, the logistics, maintenance and repair, to the front line. There is a risk of the economy overheating, unemployment rates are very low in Russia, and inflation is stubbornly staying around 9%, a bit lower or a bit higher depending on the source. Against these worries, the authors state that the government seems to still have debt and spending under control, with the budget deficit expected to reach 1.2% of GDP in 2025 and then come down in 2026-2027. But because of the way the Russian economy has developed in the last few years, a ceasefire and the end of the war may be the biggest threat to Russia's economic stability, as it is not clear how an economy dominated by the military effort can smoothly transition to a peacetime economy, where the civil sector should be dominant. Having said that, it is not Russia's first rodeo. So in case of peace, I expect they will pull themselves up by selling weapons and other military equipment around the world, and once there is peace, sanctions will be lifted and Russians will turn to the riches under their feet to get the economy going. Although this is no guarantee that the transition will be smooth. Hopefully it will not be like the time Russia transitioned from the Soviet Union to the Russian Federation, when a more or less functioning country seemed to turn into an extreme version of Sin City. It was terrifying then, and the idea is terrifying now. Anyway, time to conclude with the results of the monthly opinion polls conducted by the Levada Center. Approval ratings for President Putin and the government remain high, and overall the respondents approve of the way the country is being run. These results are consistent with previous months and seem to have remained stable since the beginning of the war, suggesting, in my opinion, that overall Russian society is stable, and pockets of discontent are limited and so far manageable and managed by the authorities. Slowly and painfully, EU-US negotiations with Russia and Ukraine are progressing. The rhetoric against Zelensky in Russia is coming down a bit and seems to move away from Zelensky as illegitimate leader to Zelensky not being good at keeping his boys in check when it comes to ceasefires. I suppose it is progress of sorts. And that's it. Thank you for watching. Please like and subscribe if you feel so inclined, of course. Have a lovely day. Bye bye.